Hi, I'm Nigel Worrall and I'm a real estate broker here in Orlando, Central Florida, and I'm here today with Chris Hurn, who's the author of The Entrepreneur's Secret to Creating Wealth. Hi Chris.
How are you, Nigel?
I'm good again. Makes a change to talk business rather than soccer.
Yeah, for once, right.
One of the first things I want to touch on is really your opening chapters in the book.
Okay.
Really the background story to your mother's input into that, because it looks like it was the most vital one.
Could have been, yeah. Yeah.
So if you want to tell me a little bit about that, obviously the chocolate side of things, the real estate, the soccer.
Sure. I grew up in a family of, I was raised by a single mother, and she's a bit of an entrepreneur. She had her own, she was a chocolatier, and she ran that business out of our house for many years. I think I began helping her at about age 7 or 8,
Right.
and kind of burned me out of chocolate for a number of years, actually. But she was relatively famous, infamous, what have you. In
so was it milk chocolate or dark chocolate?
Milk chocolate. She actually imported it from Switzerland and did all sorts of, had different concoctions and
imported it.
Oh yeah, and resold it, and even to, she stopped doing it. My guess is I would say 15, 20 years ago, and but to this day she still makes them around the holidays, and she still gets requests for people that say,
Right.
I'd like to buy 20 pounds of fudge for the holidays, or things like this.
Yeah.
So that was part of it. She also she became a residential real estate broker when I was 13, and I talk about the story in the book about helping her pass the exam, and sort of that imprinting on my brain that owning an asset, like a hard asset like commercial real estate in general, that was a way that people could build wealth for themselves.
Right.
And obviously many years later, that's come into play, and that's what I do.
Yeah,
Exactly.
But you didn't start. I mean, you also had was it a cutting grass?
Yeah, no. When I was 8, I started my my entrepreneurial journey, and in the Midwest, we cut grass in the spring and summer, we rake leaves in the fall, and we shovel snow in the winter.
Snow? I don't know what that is.
Nasty stuff.
No, I left the UK to escape snow.
Oh, well, that's why I live in Orlando now. So I've done my share of snow shoveling, absolutely. So so that was kind of, and I've had many other jobs. I've pretty basically been working since I was 8.
Right, but always relying on your own ability.
Pretty much.
Right. Okay.
Yeah.
Well, you talk about fulfilling dreams through the book.
Yes.
That's really what you do today, isn't
Mm-hmm.
it? So tell me a little bit about what you do in that regard.
Well, my contention is that we've sort of heard about the American dream from a long time, at least as co-opted by Fannie Mae and Freddie Mac, which is to own your own house, sort of your piece of the rock, so to speak. But for people that have an entrepreneurial bent, they also want to be their own boss. And my contention for many years has been, partly because of what I do for a living, is most every entrepreneur I know owns their own house.
Yeah.
If they're an entrepreneur, fundamentally, that probably means they're their own boss, at least part of the time.
And they put their own neck and their own house on the line usually.
Exactly, no question. And sort of the next dream that I talk about is, if you're a small business owner, for the same reason that you probably moved out of an apartment into a home, you should probably consider, once you've established yourself in the marketplace, moving out of where you're leasing your facility for your brick and mortar business, and actually owning the property that the business is in.
Sure.
It's an advantage that a lot of big businesses don't have, because Wall Street's breathing down their neck and wants return on assets, and obviously real estate's a drag on return on assets.
Yeah.
But a small business owner can actually, just with a little tweak, can suddenly create wealth for themselves, still paying the rent, but instead of paying it to a landlord and making your landlord wealthy, you actually are paying rent to yourself.
So it sounds like a complicated process. So how does a small business owner go from that of running a business through to owning their own property and potentially occupying it or renting it out themselves and becoming, I mean, in effect, it's another small business.
It is. That's correct. And I teach well over 90% of all of our commercial real estate clients actually set up a separate real estate holding company through which they actually take title and own the real estate. Right. And the reason we talk to them about doing that, and it sounds more complicated than it is, but the reason we talk to them about doing that is because eventually the exit strategy for most small businesses in America is not to go public. It just very minuscule amount ever do that. So what happens is, if you're a physician, you get tired, your back hurts. You're a dentist, you're a chiropractor, your back hurts after a while if you've been doing this for 30-some years, and you eventually shut the practice down, or you sell it. Ideally you sell it, but that doesn't always work out. if you're just a regular product business, maybe you're a manufacturer of some sort, maybe there's a more likelihood that you can sell the business. But the point being, if you have the operating business that you either shut down or sell, or maybe you give to your kids, or whatever the case is, but you can actually, if you've been doing this for a number of years, you've probably built up enough equity that you may own the real estate free and clear that the business has been paying for all along, and now you have another asset, which in most cases is a tremendous retirement strategy. There's a study that came out about 6 months ago that 60% of American small business owners hadn't saved $1 for their retirement.
Yeah.
Well, this is an easy way to do it.
Sure.
You know?
Sure. Well, you talk about smarter financing being the way to do it, and I
Right.
believe you've got various names for effectively what is your 504 program,
Yeah.
Smarter Financing,
Yeah.
whatever other names you've got for it. Tell us a little bit about what that program actually does for people.
Well, we sort of rebranded it the Smart Choice Commercial Loan. We did that because it's one of those inane government names, 529, 401k, 1003, all those types of things. And so I thought it was more reflective of what it was. And it's a lot of people haven't heard of it. I've often called it the best kept secret in commercial financing. And it's basically a government-backed program. Now, here's where it's different, because I'm sure there's going to be some people watching this that are like, oh, God,
government, here we go
again. Yeah, exactly. I'm from the government. I'm here to help. But the reality is, look, I'm sort of a limited government guy myself, but there are some government programs that are very helpful, and this happens to be one of them. It's actually, I would argue, it's one of the best economic development programs ever created. Right. It really is the government helping to facilitate economic development.
Which makes a change.
Which makes a change, yeah, as opposed to obstructing it.
Yeah.
What's interesting is that this particular program was started over 30 years ago, and up until the recession, this recession we had in the last 3 or 4 years, it had been what's classified as a zero subsidy program by the Congressional Budget Office. Okay?
Right.
And it wasn't until recently it's required a slight subsidy. Okay. But I think it was one of the reasons I testified in front of the U.S. Senate earlier this year is my contention is that very quickly, probably within the next fiscal year, it'll probably be back off of the slight subsidy. And when I say slight subsidy, we're talking minor. I mean, tens of millions of dollars, not billions of dollars. Big difference. But the bottom line is the program, I think over its lifetime, if we were to go back, if they did a study, they would find that it's actually produced a tremendous surplus. In fact, I know for sure it created a surplus from the fees that the lenders are charged as well as the borrowers are charged. Right. It created a surplus the last couple of years of the Bush administration. It goes into the Treasury's black hole or what have you, but nobody knows where that goes. But the bottom line is it's a program that generally is budget neutral, and it's a way that it brings Wall Street financing to Main Street businesses. And it does that through the structure itself, which we can get into in a few minutes. But the point is it basically provides better financing, longer term financing, below market financing, and it does all of this with actually having about a third to half the down payment that a commercial bank would require. And it's really a shame that more small businesses don't know about this, because once they hear it, they pounce on this. I mean, this is like the greatest thing since sliced bread.
I mean, I bought my own small business and I knew nothing about it. I mean, I don't think I qualify because basically I'm a foreigner, an alien, as they say.
Texas accent
so that probably takes me out of it, but I didn't even know about it. It wasn't even offered to me as an option. Nobody ever told me about it. So I think, most small businesses wouldn't have a clue about it in America, and they need to know. I mean, that's the reason for the book.
That's the reason I wrote the book. Yeah, and it's and I go into, there's not to be a conspiracy theorist, but there is sort of a pocketbook issue reason why a lot of bankers don't talk about this program and perhaps don't educate the marketplace as much as they should, which I won't expose.
Yeah, people can read that in the book.
I got lots of secrets in the book, and that's one of them. But that's,
we could be here all day with that conspiracy
that's right.
theory stuff. Okay, so you've got a small business, you're thinking about your long term. Mm-hmm. Tell me, where do you start the process? You talk about getting organized. Mm-hmm. You need to start getting some paperwork into gear.
Right.
What do you actually need?
Well, I give actually what's interesting about the book is I wanted to sort of there really are two big themes, okay? And we can call them the secrets or what have you. And then there's all these sort of sub secrets and details and everything else. The two big themes I want people to get across is number one, commercial real estate for a small business owner, when they own it, it can make a tremendous retirement strategy. It's a great thing they should consider doing. And I kind of call it the light bulb moment. And it comes, usually goes off 3 or 4 years into the business. And frankly, I have people all the time, Nigel, that come to me and want to buy their commercial real estate right out of the gate. You know, the idea's in the garage, and they want to. They read something I wrote.
Run before they can walk.
I'm so persuasive they want to buy their property. I usually tell them, no. Save your precious capital, get yourself established, and then come back to me in a few years. And I've had several of my clients do that. That's the one big theme. The second big theme of the book is obviously talking about the best kept secret in commercial financing, which is the Smart Choice Commercial Loan 504 loan. So, but in order to sort of tile that together, I give a lot of sort of how-tos in the book and really give a blueprint of what to do. One of the things I talk about is, as you said, getting organized. That's a whole chapter on the 7 basic documents that you need, that no matter where you go get financing, whether it's through me or anybody else, that you need to have in order to make sure that you give yourself the best shot. Because in this day and age, we are in probably the most restrictive regulatory environment ever for commercial banks. And it's not like it used to be 4 or 5 years ago. You can't just walk in and the banker's so eager to loan you money, and he pulls the bags of money out from under his desk. It doesn't work like that anymore. So
you can't fog the mirror anymore.
No, you really need to be as organized as possible. Okay. So I give people sort of a roadmap of exactly what they're looking for and why they need certain documents and what is going on sort of in the banker's mind.
We talk about, so you go with your documents to the bank, you ask them the question, how financeable am I?
Right.
They come back to you, and what do they say to you then, and where do you go from that point?
Well, this is an important point, because usually people get this backwards. Usually what people do, they've sort of come to the conclusion, great idea that Chris has got in the book, I want to own my commercial property, and they start going out looking at commercial property. Yep. And they call their brother-in-law, the residential real estate broker, and they say, let's go shopping for property. They have no idea what they're looking for. The brother-in-law, God bless him, doesn't know much about commercial property versus residential. There is a distinct difference, and I talk about it in the book. Yeah. And they're just going out. I mean, it's kind of like
it sounds like a good idea, so it must be a good idea.
Right, and then they go kill an afternoon or a few weekends or whatever the case is looking at property. And this is a really critical point, and it's as much of a critical point to business owners as it is to their advisors, whether it's their accountant or their mortgage broker or their residential or commercial real estate broker, is I have told people this in speeches for years. Get yourself, just like they do in the residential world, get yourself pre-approved before you go out shopping. Right. Don't go, as a broker, you don't want to show a $3 million property to somebody that can only afford a $300,000 property. Yeah. You'll waste your time, you'll waste the business owner's time, you're just spinning your wheels. It's this whole issue that so many salespeople confuse, activity with results. And what I say is, hey, get organized, get your 7 documents in order, go sit down with the banker, ask him what am I financeable for, and then you got a number. And anything below that number you should qualify for, but hopefully if the banker's done enough of their underwriting that they should based on those documents, you now have a number that you can go out and shop for. And that's really important, because a lot of, just like in the residential world, just because I tell you I can afford a $400,000 house, magically on the tour you're going to show me a $600,000 house, and I'm going to go, wow, and my wife's going to go, that's the house, and how am I going to stretch my dollar to do that? Yeah. The same thing applies in the commercial world. It happens all the time. It's best to get yourself prepared and planned ahead of time, and then go shopping for something that's reasonable for yourself.
Okay, so now we've decided it's a good idea.
Right.
We've got ourselves pre-qualified.
Right.
You then talk about the lenders evaluating the 5 C's.
Yes.
Collateral, cash flow, credit analysis, character, and again the conditions of the industry and the economy.
Yes.
Tell me a little bit about all of those ingredients that go into this pot to decide, this is what you can and can't buy.
Well, right now, again, back to what I said earlier about sort of the regulatory environment we're in, conditions is sort of the voice in the back of the banker's mind talking about, oh my God, we're not really having much of a recovery, GDP was just revised downward last quarter, and oh my God, this property could go down even more. And
so the feel-good factor is not necessarily there?
Not really. As I've heard it described many times, the best loan that a banker can make right now is no loan at all. Because you can't lose any money if you don't.
But that doesn't seem to be just commercial, that seems to be residential as well.
Yeah. So it's a problem. So condition is playing a bigger role than it probably has at any time in the last 30 years.
Right.
mostly what we do, and I can't speak for every lender, but we're mostly looking at cash flow. We're mostly looking to determine from the financials from the business, the operating company, can they service the debt?
Right.
Do they spin off enough cash? And usually that cash, what we're referring to here, is net profit. Okay, but if you're going from a lease situation to an ownership situation, we will add back. That's what it's called in the parlance. We'll add back what they've been paying in lease payments. We might also add back non-cash expenses like depreciation, amortization, interest expense. And totaling all those together, that gives us cash available, and then we put that in a ratio. You may have heard a banker talk about, oh, this cash flows at 1.2 times or 1-to-1 coverage or things like that. That's what they're doing, okay? So that's the principal piece. But collateral also is important. No banker is going to finance a piece of property that doesn't appraise out at least at what you're buying it for, if not more, and preferably more. Okay, so that's a consideration as well. I can't remember what the other ones are. Credit, personal credit.
Yeah,
that just tells a banker, have you been a good boy? Have you paid back the obligations you've had in the past? And right now, despite the fact that personal credit scores have been going down over the last 3 or 4 years, bankers have risen sort of their thresholds, and so that's all. This is a way to say that there's a reason why the recovery has not been quite as buoyant as it should have been, and part of it is, frankly, bankers have been sitting on the sidelines for the last 3 or 4 years, and some of that's their hands are tied.
So talk to me about the collateral side of that.
Mm-hmm. Okay.
What are they looking for currently, or what do you anticipate they'll be looking for in the future?
Well, what's going to happen for most commercial properties, you're going to need a current appraisal, okay? And you're hiring somebody who's either a state certified appraiser or an MAI appraiser, which is the highest standard in the industry. And they're going out and we're usually getting 2 or 3 approaches to the appraisal. Usually we're getting a comparison, otherwise called a comps, which is the appraiser is looking at other properties that are similar in size, similar in sort of the facility in general. You wouldn't want to compare an office building to a manufacturing plant. You want to compare an office building to other office buildings.
Sure.
Okay, you're looking at different areas of town. Again, you would hopefully not want to have a comp that's from 25 miles away, or worse, 100 miles away. Okay, you'd want a comp that's hopefully within, say, 5 miles or less, if it's at all possible. Okay, so that's one approach, and that's going to give you one value. Okay, what they're going to do is crunch numbers and say, well, based on recent sales, this is what the property should go for on a per square foot basis.
Sure.
Okay. The other way to do it is an income approach. Okay. Same type of thing, but you're looking at what do comparable properties in the area rent for on a per square foot basis, and you're going to factor that in, and that's going to give you a number. And oftentimes, appraisers will then take the 2 numbers, or there could be a third approach. It could be a as-built approach if there's going to be some significant renovations, and they can project what they think it's going to be worth.
Right. And
what you're doing is averaging usually the 2 or 3 approaches to get that. That's how it is.
Okay.
But what happens is bankers will lend, if they're lending, on the lesser of, and this is important because I have people ask me this at least every couple weeks. I get this question. They'll lend on the lesser of the purchase price or the appraised value. So let me give you an example. You're getting a hell of a deal, and you're buying this property that just appraised at $1 million, okay?
Yeah.
But you did some great deal, and you can move faster than anybody else, and the seller's getting a divorce, and he needs cash now, so he's going to sell it to you for $800,000 because you can close it by next Friday, okay?
Yeah.
If you try to get financing on that, more than likely, if you go the conventional bank route, they're going to lend you money based on the purchase price of $800,000 because that's lesser. Purchase price or appraised value is the lesser of the two. I get people constantly asking me, well, I'm getting a great deal and I want to get the financing on the $1 million. Well, that's great. What I tell them is, congratulations, you have embedded equity. Way to go, and wait a year or 2, refinance it. Maybe you can pull something out. But that's
we're working on real numbers, not fiction in the head. Even though the appraisal may come in at that $1 million,
right.
You are only paying $800,000. You can't expect to get finance for any more than that.
No, and part of that is because at the end of the day, all bankers are in the risk management business, and they're looking at their downside, and that's part of the reason why we look at the 5 C's, because we're trying to determine, hey, am I going to get paid back at the end of the day?
Yeah.
I don't know. If the stars line up, yeah, maybe I will get paid back. Hopefully I will get paid back. But they always have to look at the downside. which is if I'm not going to get paid back, am I going to be able to get out of this and hopefully get out as whole as possible? And that's what they're looking for.
Okay, well, let's talk now specifically about the 504 program, what it offers a small business guy as opposed to the conventional programs that are out there. So how is it different? Why is it different? And why should we go for it? Why should we plumb for it?
All right, plumb for it? What is that?
That's a British word for choose it then.
Choose it. Okay. All right. Plumb for it.
The Brits out there, you don't qualify, so I shouldn't use the word plumb.
They say that in San Antonio, right?
I couldn't honestly tell you. If you say so.
I don't know. I stick out in San Antonio. Here's the deal. You go, and I talk about this. I actually kind of illustrate this point in the book. If you're a widget maker, okay?
Okay.
You make widgets, and you've been in business for 4 years, and business is humming along, and you're doing well, and you've made some money, and got big future for the widget machine, okay? And you wake up at 4 a.m. one morning, and the rent's due the next day, and you in a cold sweat, and you say, "My God, I'm not getting anything for my rent payment every month. I think it's time I go buy my own property." Or you read my book, and that planted the seed in your mind. So you do what I suggest in the book. You get pre-qualified. You can afford X number of dollars, what have you. But you do what most people do first. You've been banking with the same bank for the last 4 years since you started the business, and you go and talk to your banker, and you say, "You know what? I've decided. I think I want to buy my own building. I think it's time. I'm growing so fast. I need some extra space, and I'm irritated. I woke up this morning at 4 a.m. and I didn't like the fact that I've been just sort of throwing my money away." Yeah. Banker says, "Great. You're in luck. We're one of the few banks that's lending right now." And you say, "Fine. So tell me about it." And you say, "Well, I need you to put down 25% of the purchase price, and we can do, depending on the age of the property, we can do a 15 or a 20-year amortization. And you've been a good client of the bank, so you know what? Normally we would give you a 3-year fixed rate and balloon it in 3 years, but I think we're going to do 5 years for you, Nigel." Say, "Oh, okay. Well, 25%. I was looking at that $1 million price, $250,000. That's a lot. That's going to take up almost all of my cash. In fact, it'll probably take up most of my business cash, and I'm probably going to have to liquidate some personal accounts to come up with that. That's a lot. Don't you have anything less, perhaps?" And that banker, he'll probably hem and haw for a second, and he'll say, "Well, we have this small business loan, Nigel, where you don't have to put quite that much down. I don't do too many of these a year, but if you twist my arm, I guess I could do it for you. I guess it's kind of important if you retain some of that capital to fuel your growth. That probably makes some good business sense, but I'm a banker, so I'm not real business savvy, perhaps." Sure. But usually what he's talking about is a different loan program. It's called a 7A, SBA 7A loan. And it's actually kind of given the SBA a little bit of a black eye over the years, and I'll explain why in a second. But he said, he'll say, that'll generally require about 10% down. Is that better? And you say, "Yeah, 10%, I can live. That's a hell of a lot better than 25. Sure. Yeah. And he says, "Well, and you know what? I can do 25 years amortization." And again, you say, "Wow, that's better than 15 or 20. Amortization, what a lot of people don't understand, impacts your monthly payment more than anything. Everybody wants to complain about interest rate. Am I getting a good rate? And this guy's going to give me 12 basis points less. But you know what? It's more important, the length of the loan. Sure. Makes a bigger difference. Especially if you're a business person, it's all about cash flow.
Yeah, it's about making that payment and whether you can afford to make the payment.
Exactly. Well, people don't understand that. I explain that in the book as well.
Yeah.
Okay, fine. Well, he says, "Okay, that sounds great. Let's do that." There's one, perhaps, downside. So what's the one downside? Well, today, most 7A loans are based off of the prime rate, the Wall Street Journal prime rate. Prime is 3.25 right now. Well, it's pretty low. Well, yeah, but it's kind of artificially low. I mean, the Fed is sort of keeping short-term rates down, and if I do this loan, Nigel, for you, I'm probably going to do it at prime plus 2 3/4, which is 6%. It's not bad. It's a decent rate by historical average. That's pretty low, but it's going to float. I can't fix it. Okay, and so you say, "Well, okay, it sounds good. Let's go for it." And that's usually how it ends. Okay, and what happens is the banker will either do the 7A or they'll want to do the conventional loan, one or the other.
Okay.
And The problem is that 6% 7A loan looks pretty good today. The problem is going to be 2 or 3 years from now when prime goes back up to its historical average in the 7.5% range, and now you're paying 9, 10, 11% interest rate.
Because that's going to move the payment levels up.
Exactly.
To a point where you may not be able to afford it.
That's exactly right, and it does happen, and people start squealing, as opposed to locking it in today. I mean, we are at, for commercial real estate, we are at historical lows on interest rates. I mean, the average over the last 50 years is about 8.5%. So we are dramatically lower than that.
Sure.
You know, we're in the
so it's a good time to get in.
No question.
If you do it right.
If you do it right. Well, so those are the two options. You know, option 1, option 2. What often remains unspoken is option 3, which is what we talk about in the book, the Smart Choice Commercial Loan, the 504, whereby you can still do that 90% financing. Okay?
Right.
But in this case, you're going to have a fixed rate, and in fact, what happens is you're financing 90% of the total project costs. So purchase price, any renovations, any soft costs, maybe that's permitting fees, engineering architecture fees if you're going to do some renovations, closing costs, all that gets put in a bucket, and you're doing 90% financing of that. And the way it breaks down, what's really the beauty of the 504 is there's a 50% of the total project that's a first mortgage or trust deed, depending on where you're at.
50% is
50% is the first. Okay, it's a conventional loan that a bank like mine would make.
Yeah.
Okay, usually a 25-year term. Again, if it's an older building, maybe it's a 20-year, but anywhere from a 20 to a 30-year amortization.
Okay.
And oftentimes there's no balloon payment. Okay, and we're fixing the rate for 5 or 10 years, and then it just resets. So it's very common in commercial real estate.
Okay.
Now you're saying, well, where's the rest of it? Well,
yeah.
The rest of it
sounds good so far. I'm
so far.
A half price
but you don't get half of the finance. Now what happens is then there's a 40% of the total project cost, which is in a second mortgage, second trustee. That's really the best kept secret in commercial financing. Well, that is the piece that's actually a government guaranteed bond that gets sold on Wall Street every single month.
Right.
It's below market.
So this is how the government steps in to help.
That's right. Okay. So it's below market interest rate, fixed for 20 years, has a 20-year amortization for commercial real estate, and usually it's about a point to a point and a half below market pricing. So if your bank is putting conventional dollars on the street on a conventional loan at 4.5%, let's say, this is probably going to be at around 3.5, 4, somewhere in that neighborhood. So it's pretty dramatic, and it's fixed for 20 years. Okay, and you're still only putting half the down payment that you would on a conventional loan. The biggest difference between a 7A and a 504, without getting into too much details, really revolves around the floating rate versus the fixed rate, and there's some issues around collateralization. You know, a 7A is a fully collateralized loan, which is where the SBA gets its bad reputation about having to pledge your newborn and your second on your house and all the other stuff. You don't have to do that with the 504. You're just usually pledging just the asset that we're financing. So it makes a big, big difference. And the problem is, as I alluded to before, bankers don't necessarily like to talk about it because they're doing let's say a 75% conventional loan in scenario 1. Scenario 2, they're doing a 90% SBA 7A loan. Okay. Scenario 3, they're doing a 50%. Because that 40% piece, that's really a bond. So somebody like you or me, pension funds, college endowment, what have you, is buying these bonds with the full faith and credit of the U.S. government. And so they're taking a lower yield on their bonds. It happens to be higher than where they can get from treasuries and other places, but it's because of the backing of the U.S. government. And so that piece is not sitting on the bank's portfolio. They're only having that 50% piece. And that's where the pocketbook issue comes in, because bankers are partly compensated based on the assets that they bring to their bank, the commissions. So 80, 90, 50, you can see the 50% is not going to be terribly alluring to most commercial bankers out there. And the other piece is you've got to facilitate that second mortgage, which is what we do all the time. We're specialists at this, but a lot of bankers view it as a little more hassle. And hassle factor, and you get paid less, no wonder it's the best kept secret.
I was going to say, so this leads me to a question. Would you say it's a more ethical loan?
I do. I would, actually. Yeah.
Right. Okay.
Yeah, irony, without getting myself in too much hot water, a lot of small business lenders that are out there, they will go to market with 7A and 504, but they lead with the 7A because they get compensated more.
Right.
And they only go with the 504 if, for instance, they hit the cap. See, you can only lend $5 million right now through 7A. The 504 doesn't really have a cap. realistically, you're going to cap out of about $12 to $15 million in total project cost, just because of the size of that second mortgage piece. But you got a $6 million hotel loan or something. You can't do it with a 7A. You have to do it with a 504. So it's only in those circumstances where it's very competitive, or maybe they're not terribly fond of the property type, it's too big of a piece of property, or what have you. That's when they want to go and leave with 504. It doesn't happen very often.
So talk to me more about the role of the lender. You've got a section in the book where you talk about the lender, and if you're approaching a lender, what are the important questions that you need to ask?
Well, there's a lot of questions to ask. I mean, I think I go over 8 of them in the book. Things like, what is your area of expertise? Can you prove it? Can I talk to some of your past clients? You can do it. I said this to somebody the other day on a radio show I did. They said, well, how do you know if they're going to be any good at some of these things? And I said, well, in the book I talk about you don't want to be somebody's guinea pig, and one of the quickest ways you can do is just do a Google search and go to some people's websites, and if all you see is like one little phrase 504 buried in the bottom right hand column, chances are they're not really that good at it. My guess is they're probably not considered experts at that, and you really want to deal with people that are specialists, and preferably experts at it, because that will simplify the process for you, simplify sort of the perceived painfulness of the process, save you time and hassle and headache and all that.
So they can dovetail a loan to your requirements.
Yeah, sure. So just those are some of the basics. I mean, you want to know how long it's going to take.
Yeah. Well, talking of that, how long does it take typically to close a loan?
Usually, I think our average is about 42 days from start to finish, which is, candidly, it's probably faster than most commercial banks right now.
Yeah. I was going to say, I remember the process I went through, and it seemed to take months and months and months and months.
Well, it does. And unfortunately, in times like these, when bankers are sort of fearful of lending, and when they lend, they can get their knuckles wrapped, they're not as eager to do that. Yeah, sometimes they drag their feet a bit. There is, unfortunately, a big myth about SBA loans, and I've always said, it's no longer the 4-letter word that most business owners think it is, but that this process can take months and months and months. And the reality is, if you're dealing with a specialist, you're dealing with an expert, it shouldn't. In fact, as you know, most commercial real estate contracts are written to close usually within 60, 90, 120 days with different carve-outs for when the money goes hard and whatnot. We've never lost a deal based on time. In fact, our record, I think, is 26 days from start to finish.
Right.
Now, I know...
Well, that's someone that's highly organized, of course.
Exactly, and the stars had to perfectly align, and all these things. I know there's people that can do loans in within 2 weeks, the hard money guys, but you have to understand, you got to balance that. Yeah, maybe you're getting it closed in 2 weeks, but you're paying a ton of points up front and an elevated interest rate. Maybe you had to put more money down, and so in general, if you're just your average small business owner going out to buy an office building, industrial property, what have you, you're going to have 60 to 90 days, and that's more than enough time for a competent lender to close on that property. The people that are eligible for this loan it actually works out to about 98.7% of all.
Okay, so it's probably better to ask it the other way around. Who doesn't qualify?
Well, let me explain briefly. It's you have to be a for-profit business.
Okay.
You can't be a publicly traded company.
Okay. American citizen?
Yeah. Well, as I explain in the book, common knowledge in small business lending is that you have to have at least 51% of the ownership of either of both the operating company and, if you do the holding company structure, which I get into in the book, how to do that, both of which have to be 51% either American citizen or legal permanent resident, which means you have your green card. However, there has been some more secrets we've uncovered over the years. There is a way to do it. I'm not going to get into all right now. And we've actually done a couple loans where, it was actually majority foreign owned, believe it or not. But there's some management contracts and periods of time that they've been in the U.S. and how much of their business is done in the U.S. and all these other reasons that really, I think, contorted themselves into saying, it's okay for the American taxpayer to guarantee this loan.
Right.
But those are the biggies. I mean, there's 3 financial qualifications, which you can't have averaged more than $5 million in net income over the preceding 2 years. We're coming out of the recession. There's not that many small businesses that have met that. I've only seen somebody.
Good luck to you if you have.
Yeah. I mean, that's phenomenal if you have. You probably have private equity guys beating down your doors right now. That's one. I've very rarely seen somebody deemed ineligible because of that. You can't have a tangible business net worth more than $15 million. Again, even if you're a manufacturing company, very rarely, because of depreciation, you're not going to probably be at a $15 million. And it's tangible business net worth. Right. So it's not, Gus, the widget maker, says, yep, my business is worth $10 million. Well, how do you know that, Gus? Well, because I did one of these. It's $10 million. That's where every banker sees that on a personal financial statement and immediately discounts it. But the third one, the financial one, I have seen trip up some people a few times, and it's usually when a combination of a business that probably does pretty well in good times or bad, and a smaller purchase. And let me give you an example. Maybe a physician that wants to buy their medical office condo, okay, for $300,000, and you've been a physician for 20 years, and you've built up a nice little stash of cash in your brokerage account. Now, if it's retirement, doesn't matter. That doesn't count, okay? And if it's encumbered, meaning maybe you have a line of credit against it, that doesn't count. But let's just say for illustration purposes that you've got $350,000 of cash, stocks, and bonds sitting in your brokerage account, and you want to buy this $300,000 property. Technically, you would be deemed ineligible because the presumption is you could pay cash for it.
Sure.
It's usually when I tell people go buy a boat. And then you get below the number, and you can do it. So that's it. Those are the three things.
Okay. All right. In the book, just to round things off, I want to talk about some of the myths that you bring up here.
Yes.
Such as SBA loans have too much paperwork involved.
Yes.
I mean, that's one of the things that entrepreneurs hate more than anything is the red tape.
Yep.
I know when I've submitted for loans in the past that I just hate the process. So talk to me about the myths on the paperwork side of it.
Well, it's just one of those prevailing myths. I mean, the SBA, probably more than most areas of the federal government, has done some significant streamlining in the last 15 years. I've been doing small business lending for 15 years, and I would say it is a totally different agency now than it was even 5 years ago. Right. And a lot of this is they've reduced some of the redundancy in the paperwork. Look, you're probably going to have to sign your name and write your name out 3 or 4 extra times than if you just apply for a conventional loan. But at this stage of the game, because of where we're at, sort of in the economic cycle, you're going to be submitting just as much paperwork if you try to get that loan conventionally through a bank.
Right, but term it in terms of mountains. Is it this high, this high, this high?
Depends on how many businesses you got and how many affiliates and things like that. Really, I mean, I've had a guy. I think our record is somebody that had 31 different affiliate companies.
Oh wow!
And unfortunately, if you own 20% or more in another company, you've got to give us the last couple of years of tax returns there too. So it depends.
That was a lifetime project for that guy.
Well, it kept his controller busy for a long time. Yeah, but I mean, there's a quote in the book from a relatively good-sized company. Actually, one of them here in Orlando that a lot of people know in the engineering field. A very, very bankable, financeable client. And he said it actually was less paperwork than when he went to go refinance his house.
Right.
So
for the typical small business person, it's nothing really to worry about. It's just a process. It's going to take you a few hours of your time, and once you've done it, you've really set yourself up for wealth attraction in the future.
Yeah, I think so. And always want to make a copy of everything. God forbid you have to go through and get all that a second time for somebody else.
Sure.
But yeah, I think it's worth it. I don't think it's nearly the hurdle that it once was.
Yeah, I mean, a lot of the information really is information you should have anyway in running your business, management account, etc.
Sure. Sure.
Okay, another one of the myths that we've got here is that SBA loans require a lien on your house. Now, for a lot of small entrepreneurs, that's what puts them off anything with getting a loan. They don't want to take that financial risk, so they'll continue to pay the rent. Talk to me about the lien on the house syndrome.
Well, it's also been a big piece of why I think the economic recovery has not snapped back as much as it should. Right. And that is that home values have declined so much. Right. And what a lot of people sort of on Main Street don't understand, unless you're an entrepreneur like us, you don't understand that you have to personally guarantee things. And oftentimes, one of the ways that you were able to get some of that equity to run your business, to cash flow your business, was actually getting a line of credit on your house. That was common.
Sure.
As recently as 4 or 5 years ago. Now it's very difficult to get a line of credit, a second mortgage on your house that you're going to use for business purposes. It just doesn't happen very often, partly because a lot of homes are underwater, among other things. I think this goes back to what I said before about the 7A loan, which is sort of the flagship loan program of the SBA. And it was structured to be a fully collateralized loan program. And because we are putting a 75% guarantee as taxpayers on that loan, we want to take everything there is, including the kitchen sink. So, if you're using a 7A to finance commercial real estate, which you can do, oftentimes they're going to put a lien against the real estate. They're going to put a second lien on your house, presumably because you have a mortgage. They may try to get a UCC filing on your inventory, maybe your receivables, maybe some of your equipment. Require life insurance, that they're the beneficiary, the bank is the beneficiaries, all these different things to make themselves as whole as they possibly can in the God forbid, the event that you default on the loan and they have to take back the property. It's a little bit different in the 504 world. It was never structured as a fully collateralized loan. So what you mostly have is if you're buying that $1 million property and you're getting a $900,000 504 loan in aggregate, you just have a lien, a first and a second, on that commercial property.
Right, which is a huge advantage.
Yeah, I mean,
it takes a lot of the risk out of it for you. So.
It does. I mean, you still have to personally guarantee it. You can't really get away from that. And I know, lawyers are constantly telling you, oh, never personally sign for things. Then you never get a loan.
But there's a big change in momentum from thinking, well, my house is really on the line here to that. So,
I think it's really more of a bankers have been doing this for as long as I've been in business and probably long before.
Oh, sure.
It's really a holding your feet to the fire. It's a psychological thing. Yeah. People are fearful of losing their home, and so they're going to do everything they can to repay that loan to the bank, and that's kind of why they do it.
Well, I think that's a great stopping point for our interview. I want to thank you for taking your time out of your day.
No problem.
Where can people actually get your great book from? As you can see, I've actually tabbed many sections of this book that you need to read.
I didn't know they had all those colors.
Oh, yeah. It's nicely multicolored.
They can get it, easiest thing, you can get it online. There's you can get this version, Amazon, Barnes & Noble, Books A Million. If you like the e-reader version, you can get it on Kindle, Nook, and on your iPad. What I will tell people is I'm very passionate about entrepreneurship, as I think you know. I own a lot of businesses, run a lot of businesses, I've had a lot of businesses. I think it's the greatest thing. It's very difficult, but it's the greatest thing there is, to be your own boss and to do all of that. Because of that, we desperately need more entrepreneurs, not only in this country, but all over the world. And so one of the best programs I've seen out there is NFIB, National Federation of Independent Business. They have a program called the Young Entrepreneur Foundation, where they actually teach American high school students how to become better entrepreneurs. These are the people that are going to be creating the Apples and Googles and whatnot of the future. And so what I decided to do was when someone orders 2 or more copies of the book and sends me the receipt, and it's real simple, I explain all this, the back page of the book, it's actually even built into the back cover. They order 2 or more copies of the book, send me the receipt, I'll donate all the net proceeds to the Young Entrepreneur Foundation.
All right, it's a really great idea. Thank you again for your time.
No problem.
Make sure you go and get a copy of this book.
2 copies.
Or 2 copies of this book, or 10 copies of this book even, and you'll see all the tabs that I've got. I bet your copy has one too.
Thanks, Nigel.